Hey, good evening, everyone. Marty Missouri here. Friday, the 1st of December, 2023. This is your weekly economic update, and we'll do another stock market snapshot where I will include the dollar, bonds, yields. And this time I'm going to throw in gold. It's an interesting chart, and we made a move today that I want to tell clients about. But first, the economic data. And again, not much has changed. We actually did get a little bit of an improvement this week by 2 points to a negative 27.66, still firmly in the territory that says recession, higher odds versus continued expansion. And it was interesting going through and updating the data this week. About 2/3 through it, I thought we were going to get a 2 or 3 point decline. And then I got to the market related data and then one data point on shipping that I didn't include here, but it did improve. And lo and behold, we end up with an actual increase or less negative. Okay, so again, I'm just going to roll through a few slides on the economy. The first one being personal consumption expenditures, which came out. You can see they were, I think, a little lower than expected. You can see how that trend looks, and you can see how that trend looks typically prior to contractions, but pretty darn noisy number. But anyway, so for what it's worth, downtrend in terms of rate of change of consumption. And that jives with certainly with the consumer sentiment readings of late. Personal income dropped to 4.5. I think that was a little better than expected, 0.25 on a month-on-month basis. The ISM manufacturing survey results came out. Services, which is the yellow line, that'll come out early next week. And it essentially broke even. It was actually expected to come back more to 47.8. 15th month under 50, and 50 denotes contractionary sentiment among manufacturers. Just 3 of the 18 industries that it tracks saw growth versus 2 in October and 5 in September. There were 0 industries that saw an increase in backlogs, and just 2 saw a rise in new orders. 14 industries experienced contraction versus 13 last month, with the balance seeing no growth. So again, just kind of malaise, if you will, from the manufacturing survey. I wanted to show you the U.S. Economic Surprise Index, still in the positive, which means the data continue to come in better than economists expected. However, you can see what the trend's been of late. And so better than expected, but not to the extent that it was in July or since. So waning data relative to what economists had actually previously forecast. And then the PCE deflator, so inflation coming from the personal consumptions data, that continues to go in the right direction. You can see that the headline read is 3.0%, core, which X's out food and energy, 3.46, month over month, just basically flat, right? And this is the kind of thing that gets the equity market and the bond market somewhat giddy. We're still quite a ways from the Fed's 2% target, and Jerome Powell did have a speaking engagement today, or an interview, and on one end, I think you could say he sounded pretty hawkish, but it was, I think, on balance, relatively sanguine. You see how the market couldn't get out of its own way this week leading up to this. I think the market anticipated that he was going to push back pretty hard on this dovish narrative. I actually anticipated that he would as well, and he really didn't. There was really nothing new in his language at all. So I think the market took today's really no change as dovish, and therefore the way markets are trading right now, bullish. And I've spent a lot of time on that mentality. This is very classic late cycle stuff. The Bloomberg Commodity Index, this is good news for inflation, that it's rolling over here again. Bad news for the economy when you think about what commodity pricing says about economic growth and economic activity. However, when we zero in on copper, which is historically very economically sensitive, you can see it actually is broken out of this downtrend. Remember, I told you that despite what we're thinking about the economy, copper had a bullish technical pattern here. So we had your downward sloping wedge. I've done this a zillion times on equity charts for you. and we broke above the 50-day moving average. It's now flattening out and broke above this downtrend line. So this would be bullish. This would be something traders would buy. I wouldn't right here. I can't necessarily explain it other than there's a huge correlation between the price of copper and activity out of China. The Caixin PMI, which captures smaller private companies, it's done by a private entity. It's presumably a better indication of what's going on in the Chinese economy. It was actually back into expansion territory. So maybe anticipation of more Chinese stimulus. And as I just mentioned, better business sentiment brewing out there. Perhaps copper traders are anticipating something there. I am anticipating China continuing to bring more to bear, ultimately whatever it takes to bear to turn their economy around and actually to turn their markets around. They seem to have a very definite focus, particularly on their equity market. We'll see how that plays out over the next several months. And then lastly, on the economy, this is that 1 month look at tech, financials, consumer discretionary materials, energy, industrials, and then your defensive staples, utilities, and healthcare versus the S&P. Above 100 means it's outperforming the S&P. Tech 102, financials 101, XLY, call it 101, XLB, slightly better. Energy down, of course, oil prices have been down. Industrials, definitely better than the S&P overall. However, staples underperforming, utilities underperforming, healthcare underperforming. This is unambiguously bullish about what the market is saying about the present and go-forward state of the economy. Again, does not jibe with our several-month base case, but we've got to score them as they are, and this one is bullish and went up a point in our scoring. Okay, so I'll keep you posted on the economy. Some mixed signals, but yeah, kind of more of the same. Okay, so quickly, I'll just deal with the daily charts just in the interest of time. So here's the S&P 500. Got a nice bounce today. Appeared to be a response to Powell's talk that he gave. And you can see 1, 2, 3, 4, 5, 6, a week or so with virtually nothing going on in here, right? And then we bounced right up to the July high. Okay, so good day today. Nice, upside bullish candle there. However, the fact that it's flat makes that a bearish divergence because we did hit this point here. And you can see momentum rolling over. Still looks heavy to me. Popped back into overbought territory. You can see how that looks relative to the last peak. So yeah, this is not a bullish setup, but I'll say it for the umpteenth time here. Seasonality is really strong. A lot of bullishness out there that would not surprise me in the least to propel through December, maybe burn through these somewhat bearish technical patterns. Right now, I'll just say it this way. If you just look at seasonality, if you look at end of year window dressing, professional managers trying to catch up, they could do really well if December does really well, so they buy into that early. That's very bullish. The technicals do not comport with that versus where they were the last time we were unambiguously bullish. Remember, we had this lower low and we had bullish divergences here. We had incredibly weak sentiment at the time. This thing was just more than ripe to pop. And I'm going to show you sentiment here and contrast where we are right now and actually parallel it with where we were back here. Okay, so the NASDAQ 100 index didn't do as well today as the S&P did. Good breadth today, by the way. S&P equally, it was up a bunch. I know the Dow was up a bunch. Yesterday, the Dow was up huge, largely because of Salesforce's earnings. But here's your NASDAQ. This one actually looks worse to me, frankly, in terms of rolling over, lacking momentum. Right now, it looks highly likely that it'll lose this line and come down. Could be wrong, though. Again, I think Powell saved the day in his talk today. Small caps, Russell 2000. We had these bearish single candles, and then we just absolutely exploded out of that today. A lot of pent up, probably short covering big time, and shot right up to this 62% retracement. It continues to be on the daily chart. better looking. I don't have these bearish divergences. This is lower, but the price is lower, right? If anything, you might say that this momentum is bullish, and they're still way down from January of 2021. The peak was a little earlier than that, actually. But and again, so 62% retracement, busting through the 200-day moving average. That's pretty bullish. We'll see if that can hold, and if we continue to get monster ramps here. Interesting look for small caps. Okay, so investor sentiment. So the AAII Individual Investor Survey, the green is the bulls, the red is the bears. We are at the biggest gap that we've been in. This is a little over a couple-year chart here. And the last time we were virtually right here was right, I call it 2 weeks before that top in July, when we had that pretty noticeable, double-digit correction here. You can see that this is where we were pretty extended in terms of sentiment. Market rolled over a bit. Sentiment came right down, but the minute it popped back up through the red, where there were actually more bulls and bears, that was the beginning of the end. And here, this was a different analysis. I was circling, where we were close or crossed over, and then kind of looked at what the market did thereafter. This is just a massive gap. Like here was good. Week or two left. This could easily carry in to December, and despite the fact that this is just an exceedingly wide gap that virtually always results in some corrective action, it absolutely could begin on Monday, but it could continue to go. So this is not necessarily the best timing tool. It's just a short-term signal that stocks may be getting out over their skis because everybody is piling up on the bull side of the boat. And then as for advisors, same thing, believe it or not. When advisors get bullish, we should all probably get bearish, right? So Investor Intelligence, we pay for this piece of their research. So this week's report, further gains pushed a few more skeptics to the buy side, lifting the bulls to 55.7. Bulls above 55 are signals to prepare defensive strategies. Okay, and they give you some examples of when bullish sentiment was up there. We actually track the bull-bear spread. This is an input to our own fear-greed barometer. It's at 34.8. Above 30 is considered the caution initial danger zone, right? And then the wider it gets, the more dangerous it gets, right? It got to 38.5 in July. I just showed you that individual investor sentiment is right there. This one's got a few points left to go. If we get a rally next week, we'll get there. So my point here, folks, again, is that sentiment is a pretty reliable, call it short-term risk-reward indicator. And this would suggest the risk-reward isn't that favorable versus, right, where we were at this bottom here. Remember, again, we were actually bullish right here. Look at the big gap where the bears were way out there. Big gap of bears over bulls, and we got that nice rally. Look back over here, massive gap of bears over bulls right at the first bottom of the bear market. And obviously I'm insinuating that there may be something more, but you can see when we got these peaks, they were rallies. And then the few times where we had the bulls way out there was the beginning of something real ominous to the downside. Double-digit correction. And here we are again. So folks, again, doesn't mean that's how it's going to play out. It just means that the risk is elevated here on a near-term basis. Okay, and then quickly on yields. To me, this is a bullish pattern for the 10-year yield. Today, it looked like it could rally today. You can see it got up to here, the top, the wick of the candle there. But on Powell's commentary, yields came down and bonds rallied really, really hard. So nothing, though, in the pattern that's vastly different. You certainly don't have massive bullish divergences here. You're not that oversold. So, yeah, yields could go lower. Our base case, though, just from a technical perspective, is that the setup is brewing here for yields to pop a little bit. But if you're looking out 6 months or something, because remember, we're negative on the economy on a several-month time horizon, you would expect yields to come further. This is just a short-term technical sign that yields could pop higher. And it's certainly the case with the dollar, although, again, the dollar, after having a massive move yesterday, had another positive move today, until, the Fed chairman, I think that was probably it, started talking. And, lower yields, that's what the dollar's kind of trading on right now, would be a lower dollar. So you got this interesting kind of a bearish look here in this particular candle, that could say the dollar could come back down. I think over the next few weeks, we're going to see a stronger dollar. These technical patterns tend to work really well on currencies, and they worked beautifully here. And if you just look back, falling wedge, boom, bullish flag pattern, boom. This was a long consolidation. We tracked this whole way. That's why I shaded it there. And I just kept saying this looks strongly like a downside break, and that's what we got. And then I mentioned gold. We are longer-term bulls on gold. We've owned it since December of 2019. Prior to that, I don't think I'd owned it since literally 1999. And it's done okay. Most of the gains that we have in that position have happened lately. Problem here is that we're basically pushing into, I think it's all-time high territory, actually. Certainly we're above May. We just have a classic rising wedge pattern right here, and classic bearish divergences. And we're now into overbought territory. Here's where we hit that peak. Everybody was throwing a party. I'm reading, people I follow who are really bullish gold. I'm hearing it again. Triple top, epic breakout. We're going to the moon. And, they were saying the same sort of thing here. And you can see this was just a very bearish pattern. And, look what happened. And right here, we're flagging a very bullish pattern, right? You got kind of if you want to call it a double bottom right there, but a nice bullish divergence, and you had this really big pop right here. Well, the charts were telling you this was a time to, if you're short-term, take profits, go short, what have you. And folks, while gold can continue to go, I think today was as much about geopolitics as anything. Dollar breathed some life into gold as well. We are long-term bears on the dollar for that and some other kind of structural reasons going forward. We're long-term bulls on gold. Having said that, it is our second largest individual position underneath treasuries. And so what we did today is we bought a protective put. Wasn't very expensive, and it was worth doing, to take us out to January 19th for now, just to let this technical pattern play out. This market could get really weird in a hurry. The dollar chart looks bullish. Yields chart looks bullish. Gold could take a hit right here. I'll leave it there for this evening. Thanks as always for watching and listening. Over the weekend, it's time to score our equity market conditions index. I suspect I'll just share the intro of that and our scoring in Monday's note, which is typically what I do with that. Thanks again. Have a good weekend. Take care. Bye-bye.